Good morning and welcome to the Post-Monetary Policy Committee press briefing. Today is April the 30th, 2020. As is usual, we'll have the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, giving his briefing, after which we shall take questions. As has been sent through to you in terms of instructions, members of the media, you will send your questions to us via email and also via Slido with the hashtag MPC30. That's hashtag MPC30. And you will do that by identifying yourself and the media house through which you're asking the question, and we shall then relay this. But for now, I would like to introduce the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Good morning, ladies and gentlemen. Glad to be here to brief you on the discussions that took place yesterday at the MPC meeting. We met yesterday to assess developments since our last meeting on March 23rd. Now, since then, there has been significant developments globally, both in terms of the evolution and containment of the coronavirus pandemic, and also the mitigating measures that have been put in place measures to mitigate the economic and financial effects. Now, since our last meeting, there has been a lot of new economic data that has been revealed or released around the world. And I'll quickly go through the significant elements as the MPC saw it, and then sort of move, as we generally do, to things that the various sectors or in terms of developments in the country. So in terms of economic data, first, globally. And there has been a lot of new data regarding the strength of the global economy. And the first of this is the data that has been circulated, collaborated, indeed revealed by the IMF. But there has been other institutions that have also put out their projections for 2020. And what is clear is that the global economy is in recession. And it is expected to contract significantly in 2020. As a matter of fact, the IMF projects an unprecedented -3% growth, meaning a decline or contraction by 3%. This is significant. Advanced economies, according to the WEU numbers that were released in mid-April, according to those numbers, the advanced economies will contract by 6.1%. And the emerging markets and developing economies, EMDEs, are also projected to contract by 1%. Now, surprisingly, the large economies, the advanced economies, and the emerging markets are both contracting. So this is what you may call synchronized drowning, as opposed to the other synchronized recovery and things like that. Because it's actually the first time we have both advanced economies and emerging markets on the same side, meaning contracting together. In any event, US economy is projected to decline, meaning to contract by 5.9%. Germany, 7%. China, a growth of a very modest 1.2%. Sub-Saharan African countries taken together, declining by 1.6%, so contraction of 1.6. Of course, the number of Sub-Saharan Africa is dominated by the larger economies in Africa, and in particular, South Africa and Nigeria. So this is really a significant sort of moment in terms of the projections and where the global economy is. Incidentally, yesterday, the US authorities released the first Q1 data. Now, the MPC meeting did not, the MPC member, the MPC did not look at those numbers. They only released yesterday. But I think it's worth mentioning them at this stage. So the first, these are the first numbers from the quarter. That's the actual Q1 data. And the US is contracted by 4.8%. And this is significant because it's the worst sort of outcome since 2008. And what's more is in the US, the lockdown and those sort of effects were only, let's say, they really came into effect significantly in the last week of March. So that is important because we can expect that Q2 will be a lot worse. And also there has been some rather horrible unemployment numbers in the US. And from March 13th, thereabouts, the US has lost 26 million jobs, 26 million jobs, which is something like 16% of their labor force. Today, actually, they will also be releasing this week's jobless claims. So I'm revealing these numbers, or I'm presenting these numbers in this context to show you how significant this pandemic is in terms of the economic impact that it is having globally. So again, is this background. Governments and central banks have moved quickly, embarked on significant stabilization and stimulus measures. And financial markets have been highly volatile and also unsteady with respect to their reaction to things. For instance, yesterday, after those horrible numbers, somehow the main markets or the US markets ended up, at the end of the day, they were stronger, meaning the prices, the indicators were green, were better, were stronger, which is a bit surprising that they, in a sense, ignored the information that was revealed on that day. Now, one can say that there were other positive developments, and in particular, maybe there were positive developments relating to the medical successes that are there, the race to get a cure for this pandemic. But whatever it is, it's clear that the markets are not adjusting in the way that one would expect. Nevertheless, another important development is the oil market. And this, we can only say that the bottom fell off the market. And clearly, the prices plummeted as demand shrunk by more than 30%, estimates that is, as industries are not working at the previous levels, and indeed even the demand for jet fuel and all that. So we do understand why demand has fallen. But at the same time, there were discussions about reduction in production, that is production cuts by OPEC+, and but also there were a significant development a couple of weeks ago, which is the first time that let's say one of the actually US benchmark oil price, and this is the WTI futures, fell into negative territory, meaning it was down more than 30%, negative $30 per barrel, which is obviously something that has never happened before. But it shows you how dislocated that market is. The main driver for that, aside from the decline in demand, was that there was a shortage, and there still is a shortage of storage space. So I think the point here is that the oil market will remain sort of weak, meaning in terms of prices. And this has significant implications for the oil producers and also for ourselves, the oil importers. At this moment, yesterday, the price of our benchmark oil, which is Marbon, was at $18.4 a barrel. And this compares to the average of $73.1 a barrel in April of 2019. So the average a year ago was 73.1, and that now is in the region of $18.4 per barrel. So those are the significant economic data that have come to, obviously, have been released globally to the globally since we last met in March 2020. Domestically also, there has been some data and new data. And the first of this significantly was the first actuals for 2019. And these were released on Tuesday this week. And they indicate that the economy grew, the Kenyan economy grew by 5.4%. And this is compared to 6.3% growth in 2018. Now, touching on them briefly, agriculture was sluggish at 3.6% compared to 6% a year ago, 2019 that is, and our forecast of 4.6%. This is due to the delayed rains at the beginning in March, and then subsequently when the rains arrived, they were actually insufficient. The rains did not come as expected. So they were below average in terms of the rainfall. And that's why agriculture really did not perform as was expected. That is below the average for, let's say, the last 5 years or so. But I think also importantly, there were revisions in Q1, Q2, and Q3 data that for agriculture, downward revision on those 3 quarters. And that's why, in effect, we believe that, because we already knew that the rains were insufficient and also they were delayed in coming. So when we did our projections of agriculture growth, we had it at 4.6. So the difference here is really accounted by the revisions that took place. And I think here, if we had actually used the agricultural growth number that we are projecting, 4.6, then overall GDP growth would have really been where we had predicted at about 5.7. Industry also was slow, meaning slow growth, and this is despite a very strong construction sector or outcomes from the construction sector. And I think the one point that we've been making before is the services sector are really strong, and they did not disappoint. They came in at 6.7% compared to the actual in 2018 of 7% and our forecast of 6.6. So on the whole, the numbers for, the economy in 2019 with these actual numbers indicate that there is some buoyancy in the economy, that the economy is actually still strong. Now this again is not as strong as in 2018, but in the circumstances, agriculture and all that, we think that this was a good forecast or a good outcome. So this leads us now to the forecast for 2020. What we did, the MPC did look at the new forecasts that were presented by CBK staff. And this new forecast included all new information. So for instance, all the global trends that are there, the global numbers, the ones I mentioned, in particular the April IMF real numbers, which were the ones I was quoting in terms of the growth of the global economy and each of the sectors, we used those numbers. We also used the actual numbers for 2019, the ones I just mentioned, the ones that were released on Tuesday. And also we use all the leading indicators that we have as of now, meaning they give us a good indication for how Q1 of 2020 performed. And putting all these numbers together, our projection is of overall growth in 2020 of 2.3%, 2.3%. And this is obviously much lower than the earlier projection in January of 6.2. And also in March, we did a quick and dirty revision, where we came up to something like 3.4. But I think the point here to note is that there are wide, let's say, uncertainties in where the global economy will end up. So this number is not a point estimate as such. There is a wide error band around it. Accommodation and restaurants, of course, as one would expect, will perform terribly. And our estimate here is, using all this information, is that it will contract by 50%, 51% to be precise. Transport and communication also will contract by almost 10%. Agriculture will contract by about 2%. But there are also some other sectors that will benefit, as it were, will strengthen. And information and communication, ICT, that we expect to expand by almost 5%. Health as well, the health sector will also expand by about 3%. So basically, putting all this together, our estimate is overall growth of the Kenyan economy by 2.3% in 2020. We expect 2021 to be, a rebound. Currently, roughly, the estimate is around 6.4%. But I think the point is we will obviously revise that, given all the uncertainties that we have. I want to say a few things about the balance of payments. Expected so far in 2020, we use the most recent data, and we know that overall horticulture's exports have fallen by about 12.5%. And this relates primarily to fresh vegetables and cut flowers. Those have declined quite significantly, and we can understand why. Particularly in the case of flowers, first and foremost, the auction, there were restrictions in the auction in Amsterdam where the flowers are sold. And also we had problems in terms of the cargo space as aircraft or airlines stopped flying we know the restrictions, the travel restrictions that were imposed in the various jurisdictions. And this obviously is something that has led to a decline in cut flowers. And again, that also applies to fresh vegetables. Tea also grew strongly, or rather tea grew strongly in January, February. We don't have much numbers. And coffee as well, coffee declined substantially. Now, as we know, the auction restrictions in Amsterdam are being lifted. And also there has been a lot of work to expand the amount of cargo space, meaning increasing the number of cargo flights, and that actually has already they've already begun lifting, or rather, delivering flowers in the various destinations, UK and also the Europe more generally. And we understand that new orders for flowers are in the order of 30 to 50% of regular norm. So the expectation is that this will increase and these orders will be fulfilled, particularly ahead of Mother's Day on May 10th. That is Mother's Day in Europe. That's when it's observed, but I'm sure every family in the UK will also celebrate the Mother's Day on this month, in May as well. So that is a significant development for us because these are significant in terms of values, in terms of values of our exports. Imports will decline largely because of oil. Oil, we expect it to decline by about 1 billion, by more than $1 billion in terms of the value of this. As I explained, where the prices are, and so we expect to benefit that much in terms of our import bill, overall import bill. I mentioned just a moment ago that exports, the sort of the evolution of exports as we have them, and we expect this on the whole for the year to decline a bit, largely because of the development so far and the gradual increase in horticultures. Remittances, this is an important element. It is obviously one of the largest contributors to our inflows and of foreign exchange earnings. And we expect that in March, we have the first numbers for March. They are also on our website. And generally for March, there was an increase in the remittances figures from the diaspora by $219 million US, which is an increase of about 4.5% relative, an increase of, it's an increase of 4.5%. And I'm sorry, it is from, so the monthly amount, okay, compared to February, the figure for March 2020 increased from 219 million to 229 million. So an increase of 4.4%, 4.5%. And it just shows that we haven't yet been, the remittances haven't been, let's say, significantly reduced in terms of, and maybe it says something about the onset of the impact of the pandemic on, Kenyans or the diaspora, particularly in the U.S. and in the UK. It's interesting that the numbers from the U.S. and the UK continue to grow. However, the numbers that declined were flows that from South Africa, UAE, and Mauritius, and a few other smaller jurisdictions. But I think the point here is that we are looking at the outcomes for April, because that is when we would expect to begin to see any possible declines that may have happened, because I guess like anyone else in the US or in the UK, they may be sort of constrained by the lockdowns and joblessness and things like that. So we are projecting a decline in remittances in the year, something I believe in the order of 15% or 12 to 15%. So this is how we have adjusted this. Now, there are two other things I want to mention about the balance of payments. The first is that there has been some adjustment in the primary income portion of the balance of payments, and that is in reflection. That was as advised by some experts that were looking at how the balance of payments are compiled. And this has led to a revision over the last 5 years, and this has increased overall the current account in those years. So the last 5 years, and the current account as we have it now is projected at minus 5.8%. So this is a deficit of 5.8 in 2020, and a deficit of 5.6 in 2021. Our point here is that aside from the various flows that we will receive in FDI and things like that, also we expect some significant official capital inflows And I think this has been mentioned before. The World Bank made a disbursement to support the health sector by $50 million US. We expect also another, let's say, disbursement by the World Bank. This is the DPO of $1 billion US. And we also expect, and that will be in the next couple of weeks. We also expect disbursement of emergency assistance from the IMF, and that we expect will be next week of about $750 million US. These are, in a sense, exceptional, but they will, of course, support us in the balance of payments, etc. I want to say a few things about the banking sector, which has remained strong, stable, and resilient. But just some numbers in terms of the capital adequacy and things like that. That is on our overall something like 18.5%, and that is compared to the 14.5% minimum numbers that we have, or rather statutory minimum. In terms of the NPLs to gross loans, so the ratio of NPLs, gross NPLs to loans, gross loans, that actually fell from 12.5% in March, from 12.7% in February to 12.5% in March. Modest decline. But this is on account of higher loans compared to the increase in NPLs that we saw during that period. We obviously are monitoring what banks are doing and the impact of the pandemic, of the coronavirus pandemic. And also, as I'll say in a minute, monitoring how the measures that the MPC put in place and other measures that the central bank has put in place, how those are evolving through the financial sector. We expect credit risk to escalate looking forward as a result of increased NPLs from the slowdown in economic activities. And we also expect some sort of strained liquidity due to the increased non-payments of loans, of some loans, and therefore increasing liquidity risk. And this is why some of the measures that the MPC put in place last time, like reducing the CRR, and also from the cash reserve ratio by 1%, and thereby injecting 35.2 billion into the economy. It was injected into the economy, but targeted to the sectors that are affected, or the borrowers that are affected by the pandemic. So in that sense, the banks had to explain how they are going to use those resources, and a lot of them have already done that much, and we've already released 15.3 billion, all in a few weeks. So that is a good number, and that is 44% of the amount that we indicated that was going to be released by the reduction in the cash reserve ratio. By the way, the main sectors that have benefited from this are expectedly tourism. By about it has taken the lion's share. 50% of the 15.3 billion has been directed to tourism. Real estate by about 14% of that. Trade about 12%. Agriculture about 10%. So these are the main sectors, in a sense, that will also be and will expect to be affected by the pandemic. So I think in that sense, it makes the money is going where it should have been sent, not into other sectors that may even stand to gain in this because of the shifts that have taken place in the economy. Demand for credit remains substantial, or rather, sorry, demand for credit remains unchanged, largely unchanged in the first quarter of 2020. We would actually make the point that private sector credit growth, or the growth of private sector credit, was 8.9% to March. That is the 12-month credit, or rather the credit for March, in March. This is the first time, this is the highest it's been since July of 2016. And if you remember, September is when we actually had the introduction of the interest rate caps. So this is significant. In a sense, we are going in the right direction. We expect, of course, that to flatten or maybe come down a little, particularly in the next few months. But of course, we expect this to pick up as we continue down the in a sense, overcome the hurdles, the problems that we are now seeing from the pandemic. Just one other point I would want to make. The emergency measures that we introduced and announced, let's say on March 18th, there was really that measure in terms of restructuring of personal and household and other loans. And this, we can see it's already taking effect. So far, as of March 30th, so this is sort of the very early days, as it were. Loans amounting to 9.9 billion had already been restructured and dealt with. And obviously this is a long way from the overall of about 800 billion. But I think the point here is it was only a matter of from March 18th to the end of March, so barely 2 weeks, and that had already happened. From our perspective, we need to encourage borrowers to reach out to their banks. I think part of the issue here is that some of the borrowers are waiting, I guess, for something, I don't know what, but they should be, and I ask them to go talk to their banks. I assume some are waiting for a sort of a blanket statement and a blanket adjustment. It won't work like that. You have to present yourself to your bank and then have that discussion, explain how you are affected by the pandemic, and then the rest, you can work out a relationship or an outcome that both the bank and yourself are satisfied with. I was going to say a few more things about how the banking sector as such has been adjusting, but in the interest of time, I'll just say that one of the things we've been doing is to work with the banks to ensure that they have the correct approach to the pandemic. The point here is it's not just dealing with the customers. The pandemic means that the biggest issue is really the human factor that is so important. And so banks have to put in place mechanisms, let's say arrangements, to ensure that their staff are safe, and at the same time that if anything happens, they can adjust appropriately. So it means having separate teams and things like that. It's completely different from the standard business continuity sort of, let's say, questions that we have. Business continuity is mainly about operational risk and things like that, moving operations somewhere else and things like that. But here is a case where you really need to be much more focused on the people, the protections that they have, and also remedial measures in particular ways. We have sent out specific indications to the various banks, and we have been monitoring how that is working. And so far, we are quite happy with the outcomes and the way banks are behaving in this area. A couple of things before I finish. Well, I was going to add that a key point that the MPC members mentioned or came up in the discussion is that a weak point in the sort of remedial measures, or should we say the response that the authorities in Kenya have actually put forward, is really the SMEs, the MSMEs, the micro, small, and medium-sized enterprises in the country. And this is where we need to support them in particular ways with the banks and other institutions. And here, the point that was put forward is there's an urgent need for some sort of credit guarantee scheme that is correctly structured, so there is less moral hazard, to ensure that the SMEs can actually borrow at rates that are not very, well, at rates that are affordable, because the risks are there. And if they are priced into a loan, the cost may be prohibitively high. So there is some work that is ongoing in that area, and we expect that that will come to fruition in the very near future. Fiscal developments, I think here we can say that we had a presentation from the representative from the National Treasury. And the main features here, the main factors to raise is we do have, there was a supplementary budget that was approved early in the week. And also, this supplementary budget indicates that the revenues will really be low. That is not surprising given the situation in the economy, the impact, as we know, of the various restrictions that we have, and indeed in terms of demand, as I said, external demand and things like that. So revenues will be down. Expenditures also will need to be redirected to health and also social support. So putting all these things together, we expect that the deficit will increase to about 8.2% of GDP. This is compared to 7.7% in 2018-19, so the financial year 18-19. So this number, 8.2, is actually for the current fiscal year, which obviously is just now 3 months to go. But an interesting thing, I think we want to mention two things here. In the supplementary budget, the fiscal authorities actually proposed a removal of all tax exemptions. And this is significant because, as you know, there are huge losses in leakages in terms of revenue leakages through exemptions. So the authorities, meaning the National Treasury, wants to clean up that whole area so that the exemptions are not given the way they are, in a very untransparent way and so forth, and they are correctly targeted if there is any sort of support that is given in this thing. But I think in the conversation, in the discussion in Parliament, some of these exemptions were returned or were kept in place. But I wanted to flag that because it is a major improvement in the tax framework as we have it. Another point we needed to mention is that the response measures from that the government has put forward, the fiscal response measures to the pandemic, are actually incremental and targeted. So other countries have had a sort of one package, but here is a case where actually the authorities are actually putting things in place in an incremental fashion. But I think it is also worth noting that they are trying to target it to the most vulnerable. So it wasn't sort of a blanket sort of, let's say, provision of particular benefits, but they want to target it, and therefore it will be much more effective if it is targeted to the most needy and so forth. So I finished now. Obviously, the big thing is to make sure that the health crisis that we have is reduced and it does not morph into an economic and financial crisis. And from that perspective, the measures that were put in place were seen to be effective. They have not ran their course. As I said, for instance, the cash reserve ratio, it had its own, I mean, there's still some resources from that have not been transferred to the, or rather used for supporting borrowers that have been hit by the COVID-19 pandemic. Also in terms of the impact of a reduction by 100 basis points, by 1 percentage point, the CBR, that takes time, but that is working. We have already seen that the rates have come down and even deposit rates have come down. But in light of the large sort of shock that we are seeing, the MPC decided to reduce the CBR rate, also as a signal to all of us how big this thing is. So in a rather unprecedented way, we, in terms of timing, to the 1 percentage point, 100 basis point that was put in place or reduced in the CBR last March, the MPC decided to also introduce another reduction of half a percentage point, meaning 50 basis points. Our view is that we should continue monitoring this, and from that perspective, we'll have another meeting in a month, and also to continue looking at the health side of things. After all, we are all citizens in the country, and to follow the indications and guidelines that are given to us. We understand that all of us face significant difficulties. We've never had challenges of this order of magnitude in terms of economic challenges. And I think, in a sense, we will continue, from our perspective, working with the other policymakers to make sure that we minimize the pain, minimize the cost, but we know that it is virtually impossible to eliminate it. I mean, it would be a very, very, very difficult, tall order, let's say. But we will do our part, and we look forward to observing how these measures are causing positive effect in terms of minimizing the impact on the population. Thank you very much. Now I'll take your questions.
Thank you very much. That was the Governor, Dr. Patrick Njoroge, with the update after the MPC meeting. Now we shall be relaying the questions to the Governor. There's quite a number that have come in. If you intend to ask your questions from the media, reminder to please send them to us via email or via Slido. The meeting is #MPC30. That is #MPC30. So to begin with, I'll forward two questions to the Governor. The first one is from Prince Moragori from Kenyan Wall Street. Given that COVID-19 is mostly affecting the supply side, do we expect demand-targeted monetary policy to be effective? Second question from Prince Moragori for Kenyan Wall Street. Given that COVID-19 is mostly affecting the supply side, do we expect demand-targeted monetary policy to be effective? The second question is from Dominic Omondi from The Standard. Besides forbearance on loan loss provision, has a CBK or government worked on guarantee against loans to risky borrowers, for example, SMEs? And I guess for the Governor, that was part of one of the last things that he said, but Governor, you can feel free to answer those two.
Okay, thank you. Chris, this shock is not just on the supply side. this shock actually has hit all drivers of in the economy. So first, in terms of think of consumption, think of investment, think of government, think of exports. So it isn't just supply side. And I think on the demand side, you do have, for instance, on the exports, those have come down dramatically as we net exports. We've also talked about the impact on other parts like government. So it isn't just a supply side shock. It's actually, for the first time in a long while, you have a combination, I would say a cocktail. Actually, you probably, even better, you probably use the word a perfect storm, where you have been hit both on the supply, because the supply chains have been interrupted and have been broken, and also you are hit on demand, and also you are hit in terms of the financing systems, right? So you have, in a sense, the financial plumbing may be dislocated if you are not careful. And that's why it is a difficult challenge. We've never been this challenged before in terms of demand management, in terms of, or rather economic management, not just the demand management. So it's true the monetary policies cannot strengthen the supply side of things. That we know. Those broken supply chains cannot be mended, fixed by monetary demand management policy. But on the other hand, if we do things correctly, monetary policy, monetary and financial policies can actually do a bit of stimulating demand, which is essential, and also ensure that there are no breakages, let's say, in the financial sector plumbing. So for instance, as we said, as they get their loans sort of adjusted, one of the things that is clear is that banks will have less liquidity, right? In that because they won't be getting the payments that they had expected. And so in a sense, this is why it's important to deliver some liquidity to them. So you can see from that perspective, it solves a potential problem that would have been there. And so it is that. But at the same time, you also need to be aware that, or we need to appreciate that there has to be other measures in terms of not just fiscal measures, but also social measures, social protection measures. One of the things we have here is we have a very, let's say, very informal social protection system or framework or, safety net. And those will continue to operate. And they are, at the end of the day, as I have said in another discussion, I remember Brenda, if she's listening, she did ask me a question sometime in October about GDP. She was talking about her grandmother in terms of what is the impact of, what can Brenda tell her grandmother about the GDP numbers that we were talking about then. And I said, well, I don't remember all the answer, but at one point I did say, we cannot eat GDP. So at the end of the day, we do need to provide the needed income or the needed services or the needed, let's say, food, whatever, to make sure that all of us, the entire population, has access to them. I mean, at the end of the day, it is important to see that it's a much wider problem that we are dealing with. So thank you, Chris, for asking that question. Dominic's question about SMEs, I thought I mentioned it, but just to repeat, what is clear is that the SMEs, they would benefit from some of the loans restructuring that is there. But there are actually very few of them are at that level. So in a sense, during this time and when you look towards the recovery of the recovery period, we do need to have a framework where the SMEs can borrow and minimize the risk to the lender. It doesn't mean that we'll eliminate it. We cannot eliminate the risk. And indeed, it is important for the borrower to carry their risk as well, right? So in that sense, this is why a credit guarantee scheme may be in place, may be brought in place, designed correctly. And again, as I say, that is something that we are working on. At this moment, the biggest concern for SMEs is not so much, it's not so much finance. It's actually something else altogether, which is, you know, orders. I mean, even if you give them finance, what will they do with it if there are no orders that are coming to them? So in a sense, it goes back to what Chris mentioned a moment ago. So it isn't just one thing that is going to fix this. So, and one of the things that were announced recently is there's a program which should have been launched, I think, on Monday. The president talked about it in his speech on Saturday, where that the government will provide, let's say, material to make face masks, and to the, let's say, tailors in the various places around the country. And they will be paid for making the masks. They will then, those masks will be distributed around the country in the various locations that they are in. So you can see that that will obviously employ so many tailors and other people that around those services. It is important to see that that is essential. The orders need to come in. And obviously the tailors, the mechanics, the carpenters, the fundis, all these people who are in the SME sector will benefit substantially if those orders came to them. And then maybe at that point, that's when they would get financing to buy the inputs or whatever else it is. So we are very concerned about SMEs, and thank you, Dominic, for reminding me to say a bit more about it.
All right, thank you, Governor. More questions from David of Bloomberg News. This is about the Kenya shilling, which in David's words has been wobbly in the past 2 weeks. The update, he asked about an update on the IMF standby facility to cushion the economy from shocks. From Kefa Moirore of Radio Citizen, NPLs and private sector credit growth have surprised by improving. How much more can CBK keep up its support, and what more ammunition is there?
May I take those two, please? So if the first one, David Herblin, you're predictable. But anyway, let's answer your question. I think I've said several times that I've explained our policy on the exchange rate. And I will not tire to explaining it to anybody. And I've made the point severally that we have a flexible exchange rate policy. This has served us well. And in particular, it means we do not have a target exchange rate. We do not have, therefore, direction. What we do is we minimize volatility. So if the shilling is strengthening, appreciating quickly, we will intervene. We will intervene and buy US dollars from the market and then slow the decline. If it is appreciating very quickly, if it is depreciating very quickly, we will intervene and sell US dollars to slow the pace, not to reduce and eliminate the increase. No, we don't do that. It is the volatility that we go after. So that is our policy. It has worked well for many years, and we'll keep to it. Now, in terms of what the rates were, you said wobbling. I don't know what wobbling is. I know the English word, but I don't know what that is in terms of description of exchange rate policy or exchange rate outcomes. The point, though, is we will continue with this policy, and there is no reason why we shouldn't. We know that it has worked well for us. If you look at where you are, David, just look at the exchange rate of that country and see what has happened to other countries. The point is that we are lucky, and I'll use that word cautiously, in a sense that we have a very or highly diversified economy. Our our saving grace has been the strong diversification of our economy. And as you can see, when others are hit significantly because they are oil producers or primary commodity producers, so look at the other countries, their currencies have weakened dramatically. And I think we need to appreciate that, to accept that. The structure of our economy has given, and the policy, and our policy on exchange rate has given us that stability. We are also very, let's say, in terms of our trading partners, we are also quite diversified. And in particular, we have said that we are very local and very regional in outlook. And that has helped us. I think, to me, the one thing that we don't talk a lot about, and I would want more people to write about this, is how we were, I want to say, accidental diversifiers, and how that has really helped us, the fact that we are highly diversified. We also are not, in terms of our exports, we are not all in one basket. We talked about oil, but it could have been anything else. I mean, we have tea, we have flowers, we have all these other things, horticultures. That means that even if, let's say, there's a problem with flowers, at least the others keep us going. So I think we have to appreciate that, and that has really been the source of our strength.
The second question was from Kefa Moirore with the question was about NPLs, non-performing loans, and private sector credit growth surprised by improving. How much more can CBK keep up its support, and what more ammunition is there?
I think we need to, maybe I'll answer his question. Keva, I'll answer your question, a slightly modified question. The question is, how much firepower does the central bank have? I think I mentioned this last time. We don't know how bad things will be. If we knew, we could measure ourselves, sort of. So if you are running the marathon, it's 26 miles or 42 kilometers. So you know how to save yourself and to conserve your energy during that period. We don't know. We are going on a long journey, and we don't know if it is a marathon or 2 marathons. We still don't know. Now we have an estimate of where more or less it would be. But as I said, we still have wide margins in terms of where things could go or could go wrong and things like that. So the point here is that this is why it's important to assess things and monitor things in a continuous fashion. The point is that, therefore, we cannot use all our ammunition. And that's why the MPC has taken a sort of a measured approach in everything that it does. And so, yes, we do have a lot more firepower. Look at all the policies that we have, and you'll see they are what we call policy buffers, meaning we haven't worked ourselves into a corner. Yeah. Also, in terms of signaling and all those other things, we have adequate foreign reserves. We also have, so in a sense, that's a second layer of protection in some of these things. And also, there are other things that can be done in terms of fiscal policies, fiscal measures that could also end up strengthening us in various ways. So, I mean, think, for instance, when the pending bills are paid, that actually has a strengthening impact to a lot of the small producers or whoever else is paid those pending bills. And also, eventually, it strengthens, it brings liquidity into the system. So there are many other sort of channels, or should we say, dynamics that take place. So I would only say that we do have adequate policy buffers going forward, and we want to save them. We don't want to use all our firepower in the first battle. We want to preserve us, to save, to maintain something in reserve, in the back pocket, if things get really bad.
Okay. From Martin Muita of The Star, kindly clarify timelines for the measures to support SME borrowing. The second question from Martin as well, the 9.9 billion shilling in restructured loans, which sectors are they from? An additional question from Dominic Omondi from The Standard. After locking out unregulated mobile lenders from the credit information system, is there a plan to bring them into regulation?
Okay, let's take that. So, Martin, I cannot be more precise in terms of timing. There are many players in this, not just ourselves. We are working with banks. As a matter of fact, over the last week or so, I've had a lot of meetings with banks, with the players in this area, banks, government officials in particular. We've been conversing also with CS Betty Minor. And also we've been having conversations with the development finance institutions, IFIs, World Bank and others, because they also have, they can work with us to put together quickly such a scheme. So I think all I can say is we are working flat out, and hopefully we'll get something very, very soon. Martin, I missed the second question. I didn't write it down.
The second question from, excuse me, from Martin was about the 9.9 billion shilling in restructured loans. Which sectors are they from?
Okay. I cannot see my numbers quickly here, so the only thing I can say here is that most of it was 31%. Yeah, okay, I get the numbers. 31% of that was tourism, real estate was 17%, building and construction 17%, trade 12%. So it follows the your expectation about the sectors that are hit the most by coronavirus. Omondi was asking about the mobile lenders. Of course, we've made this point before that we want to regulate these lenders correctly. Our problem isn't just how they deal with the consumers. That is a big problem, but it has to be seen in totality. And so far, they have actually offered to have conversations with us, which is okay, we will. But I think the most important thing is we are working, I hope very soon we'll have something that we can, a framework that we can use for this working with, or should we say regulating mobile lenders. I've always found it odd, really, that you cannot open a kiosk somewhere, you know, even any kiosk without a license. I mean, even now you have to follow these protocols that the Ministry of Health has put out, and they need to be sure that you're following them. So you expect that you can just begin lending randomly to people. Nobody knows where your money is coming from. Nobody knows how you're lending. And finance is the most highly regulated sector in the world. I mean, finance and medicine, I mean, those are the two most highly regulated, or health more generally, those are the two most highly regulated sectors, with good reason, So I think the expectations that just because somebody is lending using a mobile platform, that allows them to do whatever they want, that I think is just being, maybe they go to the Wild West. That's where they belong, not to a proper economy. So I think that's the issue for us. And we've made that point before. And so, yeah, we'll deal with them. But I think, again, as I say, we are working in this area. And it's also good to see that the sort of high, let's say, very the positions that they had taken They have kind of moved away from that and are much more amenable to, there were discussions at the beginning about, well, they said, well, we are going to self-regulate. Yes, exactly, self-regulate. You tell me which doctor self-regulates themselves. So I think the point is they're being more realistic, which is good. Then we can deal with it. But I don't want us to engage in sort of a kind of a fight. That doesn't work. And those that cannot believe that they cannot survive in a sector and supervision, well, we are fine. Let them go. Let them go. This is not their place.
A few final questions. The first one is from Brenda Kerubo. I believe she heard your greeting to her governor. Brenda asks, CBK is working with commercial banks to ensure that they have the correct approach to the pandemic. How is this happening? Because there are concerns among borrowers that some banks are not cooperating. How is CBK ensuring bankers do not behave badly?
Very quickly, let me answer that. As I said in my comments, Brenda, the issue here is that some borrowers are going to the banks. Well, there are two issues. First is there are some borrowers that have not yet even visited their bank. And that is surprising. Somehow, I guess the expectation is there will be a sort of a blanket decree. But we say that is not how we do business. They have a contract with a bank. Let them go to that bank. The bank is willing and ready to have a conversation with them. And they have to present their case to them. That's how it works. After all, they are the ones who presented their case when they wanted to borrow. So why should they be shy of having that conversation with their banks? That is one. The banks are willing to have those conversations. That is the first point I wanted to make. Secondly, when you have the conversation, present your information, present your case like you did when you went in to borrow. So to go there with an expectation that it will be done in a sort of, cursory way, where you are, the bank says, okay, come in, next one, and, let's change it in this way. It doesn't work like that. It has to be done in a case-by-case way, where you present your case. Maybe for you, you have significant problems in the next two weeks, that's what you have, or 2 months, or something like that. Fine. But maybe for another person, they have a different sort of problem. And there are some that have gotten some sort of accommodation of their interest payments. There are others that have had interest and principal. The decision is not to have a uniform sort of cookie-cutter approach to everybody. No, it has to be specific to your conditions, to your circumstances. So please urge them to go to the bank and present their case. They borrowed, so they know how to present their case. And they will be, the banks are willing, all banks are willing to listen to them.
All right. I was foreseeing this as being the last questions, but there's a couple more coming in, but we're trying to combine. And so therefore, to Prince, to David Herbling, and to Kefa, I think your subsequent questions have been answered either in this question and answer session or within the main presentation that the governor made a few minutes ago. So the subsequent ones, Jimmy Mbogo from K24, what are the other measures that CBK is likely to take to cushion borrowers besides lowering CBR? The next one is from Otiato Guguyu from the Business Daily. How much in short-term bills does the government want to restructure through switch auctions?
Okay, Jimmy, I thought I answered that question before. And Jimmy, I can see you in this setting where you sat, where you generally sit over there somewhere. But anyway, you're asking these questions in a different medium. So I don't want to repeat what I said, but suffices to say that we have a lot of ammunition. We still have a lot of firepower. There are many things that we can do. I don't think at this point I want to list them because I'll I'll forget one or leave out some, and then it will be, it won't be the same. But suffices to say that all the policies, all the options that other central banks have, we have the same. Obviously, we do understand our specific differences. Not all banks are similar. Not all central banks are similar. I mean, or rather, central banks are not identical. We try and do things in particular ways, but the differences, the legal differences, there are some policies that we can run or we can do and others cannot, and vice versa. So within that framework of policies, I think we have ample latitude to apply. But I think the issue, colleagues, should not be, don't focus too much in the future. Look at now, and this is what the MPC is doing, trying to see how those measures that were put in place in March and the measures that we have been putting in place since the last MPC meeting a month ago, how those measures are causing a positive outcome or supporting the economy broadly and also specifically. That, I think, is where our focus should be, because, as I say, they're still working through the system. It wasn't a sort of, we didn't expect that those measures would have their effectiveness right away. It's like any medicine that you take. I don't know of any medicine you take once and then you are done. It takes time to work through your system, so that is where that is. Gunyunyu, I don't know about this question, but I think I would say two things. We have been in discussions with the various investors, some of the large investors that you have, because of a specific, let's say, mismatch in the, when there are a lot of securities that are falling due, there is generally a match with a new security, right, generally. So there's a sort of an amount of, you could say, those investors have an option there and then to roll over to a particular option. And generally, it's well telegraphed before. It is even put in the newspapers. Well, not anymore. It's put elsewhere. By the way, you can get all our information by going to the website. You don't need to go to any newspaper to get that information. In any event, website, Twitter, and other channels. So the point I want to make is that there is actually one large T-bill, 364-day T-bill, that is coming to maturity. And we wanted to offer a sort of a possibility of other instruments or other into a long-term bond or whatever. But again, this has to be done in the context of the investor. Nobody's been forced to get into a particular scheme or whatever it is. If the investors are interested in that, that is okay. If they are not, that's okay. It has nothing to do with the sort of financing requirements of government. That, by the way, is way ahead. I didn't bring the numbers today. They are on my desk. Forgot to bring them up. But you can imagine that we are actually much further ahead in our borrowing program. And we are somewhere around 80, I believe it's 84% of the way to June, around that. It could be 70, 77, I don't remember the precise number. But we are way ahead of, in terms of the borrowing program. So that's what it is. It's not that we are interested in changing things for other reasons. It's just providing more options to particular investors because that maturity is not matching with a significant, let's say, investment portfolio, investment option at that time. And the rest we leave to the investors. It's their decision, not mine, not yours. So let's leave it to the investors.
Right. The final ones, although I'm seeing some flooding in, but most of them have been answered, like we said, within the presentation and as the question and answer sessions have been going on. Abiagina, the question on COVID-19, I believe, and reserves has been answered by the governor, but there's a question here about digital lenders, and what Abi asks is, digital lenders have taken a break from lending. How will this affect liquidity in the economy?
How much did they lend before? I mean, it's kind of interesting. Barely 1%. So they are a little flea in the economy. Please, go ahead.
All right, George Bulutsa from Reuters. Sorry, I need to scroll through my emails to find George's question. So the questions from George Bulutsa, one of them has been answered with regard to the level of remittances. He sent this fairly early. The second question is, what amount of money do you think would be needed for interventions to de-risk lending by banks to cushion MSMEs in measures like the credit guarantee scheme that was mentioned in the statement?
I don't have an estimate of that, but I think the point is we are thinking of having a fund that would be somewhere in the order of 500. But I think the numbers, the details will be worked out. So I hesitate to give you specific directions, because at this moment everything is being put together. But I'm just making a simple point that if you did something like that, then you need to be sure that you have enough firepower to support most of the, or some of the, or the critical SMEs. So we are thinking of a fund, maybe even 100 billion. The 500 million was something else, somewhere in the order of 100 billion. But these are things we need to work out. So give us some time, give us some space. You'll hear from us soon.
The final question, which is fairly straightforward but very specific, from Fadhili Kanini. He asks, horticulture exports are expected to decline due to the impact of COVID-19. How much will tea exports help maintain the current account, well, the current account deficit levels?
So Kanini wants a very specific answer.
Very specific question with a very specific answer.
So let's see where we go. No, not here. Oh, here we go. No. Oh, here we go. There we go. Okay, fine. So we expect tea exports to be US dollars. Yeah, I said reasonably flat. So 1185 million US dollars. So 1185 million US dollars in 2020 against 1115 in 2019. So if you think of it in terms of share of GDP, it's roughly 1.2% of GDP in both 2009 and 2020. So Kanini, there's your specific answer.
And with that very specific answer to Fadhili, we almost come to the end of our press briefing for today. There are some questions that have come in, but again, just look at them. Abiagina with the question about when the COVID-19 effects taper off. I think that's been answered by the governor, and are reserves sufficient? I believe that's been answered as well. And the rest that have come in, especially on Slido and on email, consolidating them, most of the answers have come through. So thank you very much for joining us now this afternoon. We expect, as the governor stated, to have another monetary policy committee meeting towards the end of May, and the statement coming from that, and a subsequent press briefing as we usually have it. But for now, thank you for being with us. Thank you for joining us, and we'll see you at that MPC press briefing.